Hello, everyone, and welcome to Gregory Santana's Winners and Losers for October 21, 2019. RCL keeps the lead over Nike with 24%. So let's go see the action today. Alrighty, I am not in my usual element, so I have to try to figure out what I'm doing here. I apologize. I thought I had this under control. I do. Ha ha ha. There we are. Whoa, look at that. That is a long-legged doji dragonfly. That is bizarre. It also indicates that there's a lot of action going here at RCL that has very strong uptrend. Now, looking at this and looking at my long distance, my long distance defender down here, I moved it. We should have been stopped out, but we weren't. Why? Because I used a stop limit, and my stop limit is set for half of the option cost, which is about 280. So there it is. So apparently, whatever it spiked down here was not enough to push the option price down to the 280 marker for the stop limit. So we're in the trade, and we are owed 597 with a 132. So that comes out to about $465. It's in our good. All right. That said, there is Nike. What is going on with Nike? It's holding on. Unfortunately, it fell back a little bit. But the good part is we're still in the trade. I was anticipating us to be out of this trade on today. Remember, I did the calculations with the ATR, and the end result was that this was in an ideal, trading venue, we would be looking at getting out around here based on the ATR. Well, it didn't happen, and we're within pennies. I mean, it was just a few pennies of what's going on. But still, nonetheless, we are 735, and there we are. So, who are our next leader is XLY. XLY is right here, and I'm going to have to adjust this timer because this thing is really annoying. There. Okay, so like I said, I'll keep my mouse. I'll be quiet. I'll be good. I'll be nice. All right, play nice. All right, so here we are. And ideally, we're looking at trying to reach this marker and this level based on the ATR and how much money is owed to XLY in this trading session. And recall that this is the amount owed by AMC, a low-hanging fruit, which is a penny stock, which has gone dead. So I will have XLY pay for it because it was some kind of consumer staple, I believe. Once it's assigned, I'm done. I don't go back to it. I just, once I get that money back, then we'll move on to the next trade. Okay, going on to quad. Now this is turning out to be a delightful surprise because quad, as we saw a couple of weeks ago, a couple of weeks ago now, we're in this doji zone. It was like, egad, and the end result is there it is. So we had calculated that on an older delta, our exit would be here. Now it's moved down to here, and now we're 598. Those of you who have been with me for a while, this was, I think, got as deep as $1,500, and our target is 418. So let's do the numbers on them real quick. 418 is owed. We're behind 598. We are looking at 1,300 in contracts. So we have to get 78 we have to get 78 cents on our option, and that would be it. We get 78 cents move, and now that's the price action. The rule of thumb is on the option, looking at 38 cents. I'm a little bit tired. I apologize. So I'm not thinking too clearly right now. But go ahead and check my other video, and then you'll be able to figure it out. But right now, I'm just going to hold on. It's looking good. We have 13 contracts in play. We have 598 to break on, and then get back 418. So when we see 418 positive here, we know we're in the we have just got something from the loser circle to the winner circle. Coming on to XLV, and remember this XLV I thought was going to give up the ghost, and it's holding on. We do have till January. We are looking for a low-hanging fruit of a stock that was once known as LIFS. There was some kind of life science. That's why this health ETF is the health sector. So we'll just hang in there. Where is my stop? My stop is running here, and we just do is keep it out. All right, let's wrap up the Tigers League. Tigers League has PG. Remember, on the Tigers League, I did invoke a long distance defense. Why? Because I failed to put in a proper stop over here. Since I have the time, I'm going to hold on to it. So now what I did over here, what you're seeing here is in a perfect trading world. In a perfect trading world, these are the angles of attack. This is your normal, like moving along slowly, and this is your rocket. So somewhere between here and here, we're going to be looking at the action. We are 867 owed. We are 1452 behind, and we have 6 contracts in play. So, yeah, we'll do the numbers. Let's go ahead. 867 owed plus 1452. There it is. 2319 divided by 6 contracts, which is up to 600 shares. So we need a $3.86 movement to get to the price target. Price target is closed today, right there, around 19, round off to 119.20, and so we're looking at 123 price target. So somewhere in here, we should be good. Somewhere in here, we should be good. So that's what all these little drawings are. All right, that takes care of the alphas. Let's go to the Tigers League. Now, Tigers, unfortunately, we still have an outstanding pending order. It didn't trigger, so we have to come here and figure out what happened. Is it still viable? And if it's not, then we take our money back, and then we go, as one of my fellow traders says, we go hunting. And it's not looking good. Okay, I can see I was doing what I call a Tiger League, which you guys can see, and it was a call hawk, and it didn't happen. We also have a downtrend here in the stochastics, and we have a downtrending on the MACD. That said, how will this order cancel? Well, this is a hawk order. So being a hawk order, it has to break below my middle defense. If it breaks below my middle defense, I will then cancel the order and take the money back. And then all the indications look like it just might happen. So there we are on that. So let's just go to TLT. TLT is our put. Remember, we're doing a put here on TLT. And so that means that's exactly it. That's what we want. This is a Tiger Hawk put dropping down. So now the Tiger Hawk put is at 2 contracts and it's $20, and our target's only 60. That's all we need. We got to do is get $20 back from TLT plus an additional $60, $80 total. Hold on, exit with the profit, and then TLT will be removed from the losers list to the winner's circle and be one less loser to carry. Going on to Edison. And Edison also was a put at the beginning, and Edison unfortunately now has crossed into the positive zone of the 30-day moving average. So what's going to happen here? We have till February. So we are in a Hail Mary. Now what's a Hail Mary? Hail Mary is that long distance line. You see that one there at the top? That's my blue line. Then down here is my blue line on the other side. So this being a hawk put, we are going to hold out to see if it doesn't break above that blue. And that calculation is determining to be about a 50% behind, so we're at 15%. So this is about a 45% minus 40 percentage. Remember, options are going to go 50%. You get 50% on the outs, will be fine. Going on to UAA, Under Armour. Now, Under Armour is a call. It's short 132 bucks at 17.5. It's running 8 contracts. Now, we got into 8 contracts because this option became very inexpensive, 94 cents. So with our spread calculator and our risk management calculator, we came up that we can do 8 contracts with the money that was available at the time that UAA came up for availability. So it's not looking promising down at the MACD, but the stochastics is. Now remember, stochastics will lead. It's like going to a dance and being asked to a dance. That's your leader. But the problem is when stochastics gets on the field, MACD takes over the dance, and then we just watch it. So there we are. Going on now to our last and final for the Tigers is Dominion. Dominion was a put. It is really getting bad, and it looks like it's going to be taking it out here. We are doing a last bar high. It's going to stay in the ballpark. Now, is there any hope? Well, let's go look at the indicators and see what they say. Nope, indicators say that we are going to be losing this put, and that would be pretty much it. It will be adding this 2 contracts, their losses will be adding to this, and then we'll just have to wait for another opportunity. And remember, this trade, I have to admit to you guys, this trade was an error. Why? I did a put on the north side of the 30-day moving average. No. Darren Kimoto, one of my top 5 instructors, would be slapping me silly right now. Hopefully he's not watching this. Sorry, Darren. All right. I had an interesting conversation with a gentleman about options, and he knew about options, but he's not an options trader. And he went on with the common mantra that we hear in the general public of those who don't know options trading in the way we do it in options trading. 90% of options end up worthless. That's true, providing that you're selling the put and you're writing the option to expiration date. We're straight calls and straight buyers. So I'm buying calls, I'm watching my price action, and I will be out of the trade before the 90 days. And remember too, at the 30-day market, we go to the last bar low. So the point coming to is that, yes, it's true, 90% of the options go worthless, but that's when you are selling it. When you sell something, you really don't want it returned back to you. You want to keep the money. That's what selling's about. So you sell what they call a put, and with selling a put is that you're collecting the premium up front. So you limited your amount of money how you can make. Then after that, but they don't tell you also too, when you sell a put, you got to have 100 worth money a share. So let's say this Dominion is a good example. So let's say that you sell a put on here going up, and you say, okay, the strike price is going to be this $80, just below the 30-day moving average. Well, now you have to have enough money. You have to have $8,000 in your account to cover that trade. That's what selling a put's about. You collect the money up front on premium with an assurity that if it fell in value to what the strike price that you would get on, then you're forced to buy the 100 shares of the stock who has just fell down and and hit the strike price. If it continues going up, that's where your 90 days, that's where your mantra says 90% of the options end in worthless. Well, that's what you want. You want this put to go to zero because you collect the money up front already. It doesn't matter. So the thing ends up worthless, and you end up keeping the premium. But so the good part about it is you get the money up front. The bad part is that if it goes against you, you got to have the money to buy it. That's also too, you don't make as much. You make, it's a snowball. And those who understand and work with it, they'll sell the put for this month, collect the premium, add it to their coffers, go find something else, not necessarily the same thing, sell this put, collect the premium, go out, find something else, sell its put, and the idea that over time you build. It is the Warren Buffett style of buying stocks at wholesale. That's one of his trade secrets. His trade secret is that he'll sell the put. Why? Because he's being paid for the time he's waiting for the stock to either come down to his entry price, which is like $80, or continue going up, and he keeps collecting premium. And when you sell a put, you do want to go worthless, but you don't buy a 90-day call. You don't sell a 90-day put. You sell a 45-day or a 30-day or a 1 week. Why? Time decay. And you have time decay working on your side. So the end result is you collect the premium, you wait out the time, you keep the money, you go back to it again. That's what selling puts is about, and that's the whole thing about, oh, you can collect this money up front. Look at it, you made $300 in 5 minutes. Yeah, I hear you, James Architecture, but James Architecture does not tell you the other two caveats. The other two caveats, you got to have the cash to be able to buy that stock on obligation if it falls down to the strike price, and it also doesn't tell you that some people thinking that time is on their side will end up buying something longer than what they need to. So that's, I'm gonna get off my high horse about that, but that's what. So when you hear the mantra, options go worthless, 90% of options lose money, it's true. But that's only in the selling arena, and that's also true in the spread arena, where you buy and sell something at the same time. You sell up, you buy. I mean, let's use an example. If you sold a call, you buy the call for 94 cents and you sold a put for 4.57, that's called a credit. So the end result is you get to keep the difference. That's what it is. Now, I use a poor example because the numbers are right here in front of me, but you actually would do it on the same stock. You would sell, if the stock is uptrending, you would sell the put and you would buy the call. And that would be a debit spread because you would be paying more. If you go the other way, where you end up selling it bigger and selling it smaller, then you're going to get a credit, which means you get the money up front, but you're going to be limited. That's the thing. This is where, I mean, good example. Let's go to Alpha, back to Alpha account. I mean, Nike is sitting at $735 on my call. Now, for those who have been following me here, this was up like the $800 and something a few days ago. So Nike gets through its situation, and let's go take a look at Nike. So I'm waiting for Nike. Right there is a good example. Nike hit a little bit of a plateau. My stop is right here, and if Nike decides to come back, I'll get out. But if Nike continues to move and we get past our 1010, I'll definitely be showing up the shop. So back to that notion. If 90% of options are are worthless, that's true. But it doesn't mean you didn't make any money. If you sold the puts, you made money. If you did a credit spread, you made money. 90% of the options go worthless, and if you bought a call, that means you held it to excuse me, you held it to expiration, which is a no-no, and also you didn't put a stop when the price goes against you. So you have to use stops to protect the capital when you get into the trade and protect profit when you cross into the profit zone. And yeah, 90% of the options is true. If we did that with calls and puts, let's say, so we do calls, and 90% of our calls are going to go worthless, and we're going to lose money. Well, if that's the case, that means that 90% of the stocks that we pick, if we do 100 trades, 90 stocks are going to go down. Well, if we take the same statement, 90% of the options are worthless, and you do call and you do puts, that means 90% of the options are going to go up. That's where it doesn't work. The 90% rule, or the 90% thing about options go worthless is true, but only in the context of the arena that it's in. And traders need to put in their stops for those reversals. And we're not going to have reversals. I'm telling you, the whole purpose of these videos that I'm doing, and I'm sorry I'm really long-winded on this, but I want to just get it out. The whole purpose of all these videos I've been doing since September, I'm working on my lost leaders list. Alpha has 67, I think, lost leaders. Tigers has something like 20. I have another account that we have, we get enough time on this, but I do have another account, and it only has 10 lost leaders. And I have another account that only has 2 lost leaders. So I work on those lost leaders, and I get my money back. You lose a battle here and there, but you stick with it. You have a good trading plan. You stick to your rules, stick to your discipline. You win the war. I've told you, those who follow me since September 2nd know that we have retired at least 5 or 6 lost leaders to the winner's circle. At least 5 or 6. And now we're working on the opportunity here at TLT. There's one that's very close to getting taken out. Go back to Alpha. Nike is about $300 short of being taken out. RCL was short about $400 something from being taken out. So, and yeah, I got these losses down here, and if they go belly up, they go belly up. I just add the money and come back and wait till we have an opportune time to get into the trade again. Remember, stocks are recyclable. If you lose a trade on a particular stock and you say, I'll never trade that stock again, never, lost me money, I'll never go back. I guarantee you in about 2 to 3 years, you will have no stocks to trade. Seriously. You do Apple and Apple loses, oh, I'll never go back to Apple again. Then all of a sudden Apple goes through the roof. It happened to me. Apple owed me $1,600 in 2017. I did a rogue trade, not very smart. I broke the rules. I paid the price, and it cost me $1,600. And I only have I listened to everybody about Apple this, Apple that. I only have myself to blame for listening. I should have stuck to my rules. Bottom line, Apple swung back into profitability, and in 2018, Apple paid me back all my losses with a profit, and they got retired to the winner's circle. That's why you don't see Apple here. How come you don't see, what's another one? Oh my God, Facebook. You don't see Facebook here. It's in the winner's circle. It's already paid me back my money. I'm only going after my lost leaders, and you can I put up how much they owe us. So when this 1010 gets retired, you're not going to see Nike back unless, and there is an unless, I do a lost leaders and I step to all my lost leaders looking for opportunity, and nothing shows up on the radar. Nothing shows up on the scanner. Nothing shows up stepping through and viewing the charts, examining the charts individually. It's happened. Why is Nike here with a 10-10 and I have lost leaders that are in the 500s? Because none of the 500s had opportunity of getting in. And by the time I got to Nike, Nike popped up on the screen and Nike qualified to get in. Now I'm sitting here. If Nike gets taken out tomorrow and I get $600 out of it, that drops this to $510. I mean, look at Quad. Quad was like $1,500 behind 2 weeks ago. And with Quad, all we have to do with Quad, we're only talking $1,418 on the O, and they're $596 behind now. We made back almost $1,000 since the Quad went really low. Then I stuck to my guns. I wouldn't surrender. And I got 13 contracts. That's 1,300 into the negative, which means I only have a little bit to get out. And you can see I plotted this here to see how accurate this comes off the ATRs and the option delta. All right, that's enough. I mean, I really got carried away. I apologize. Probably this is one of the longest videos I've done, but I got it off my chest explaining not 90% of the options. People lose money with 90% of the options. Options go worthless. Yes, they do go worthless. But if you're selling it, remember, you want it to go up. You want it to go worthless. You're going to buy a weekly option. You're not going to get a lot of money, but you think maybe depending upon your account, how much money you have available, and you might pick up 50, 60 bucks a week. It already depends on how much money you have in your coffers to back up the trade on the selling those calls and puts. And then there's covered calls. Covered calls is a similar thing. You buy the stock. So if you bought the stock, let's go back to a nice one here. So if you bought the stock here, at Royal Caribbean at $111, and you need to buy 100 shares, you gotta have $11,000 in the trade. Now you own 100 shares of RCL. Then you turn around and you sell the call. It's the same thing about the idea of selling the put. You sell the call, and the call price to sell on RCL is right there. The bid, that's your sell price right there on the call side. So you can sell. You can go ahead and sell this. You can sell a covered call for $2.10 and wait out till January. You collect the $2.10, but now your money's tied up to down in January. So again, I apologize. I just get really riled up with this stuff. But here's your monthly option right there. So you sell this for you sell one contract, which is $100. So you pick up $100 between now and November 15. And it's $11,000 of you're holding RCL for $11,000, and the shares are yours. And if they have dividends between now and the time that you do sell them in the future, you keep the dividend. So if they pay, let's say they pay 2% per year, that's an additional 2%. That's an additional $222. Now it's not a lot of money. I know that. Over a 12-month period, it's like okay, but that's what this whole thing and notion about options ending worthless. Do they end up worthless when you buy a call, buy a put? Sure, but that's if you hold it to DTE, date to expiration, and you're not supposed to do that. You buy 90 days, and then you watch your price action. When the price action goes in your favor, you start moving up your stop right behind it. So eventually you get stopped out with profit. And if you have a debt like Nike has, we get stopped out and reduce the nut. Take this rock down to a pebble. I have one stock, and I'm going to stop. I have one stock that owes me $9. It's a penny stock. owes me $9. I am watching it like a hawk. I want my $9 back. That's right. And I want to take it off my losers list. That's right. Another one owes me $45. I'm watching it like a hawk. And as soon as this starts climbing in and gets into my entry pattern, zone, like here, I'm in. And my laws of probability, I will pay off, and then that loss will become a winner, and that get retired off. So the eventuality is that you guys are observing over the next several months reduction of my lost leaders list. That's it for tonight. I thank you very much. I know this took a long time. It's probably but I apologize, but I want you guys to get the word on it. All right. I take care. Thank you. Bye-bye. My closing banner. And now we can stop.